Assalamualaikum and good day to everyone. We are from Group 2 and would like to present about Proportional Reinsurance Treaty. These are the team members. The first one is Hanim Farhana, Nur Izrina, Wan Shazwani, Aifan Najiha, and Daniel Imanul Haq.
Proportional reinsurance treaty is a type of reinsurance in which the primary of the ceding company and reinsurer maintaining a post-transfer relationship. It also requires assessment of all risks by proportionately share the amounts of insurance, policy premiums, and losses for all parties to the agreement. Ceding company is bound to cede, meanwhile reinsurer is bound to accept and agree a proportion of the risk. Therefore, cedents and insurer proportionately take the same share of premium and pays the same share of any loss. There are two types of proportional treaty: quota share treaty and surplus treaty. The first type of proportional reinsurance treaty is quota share treaty. It is a type of pro-rate reinsurance contract in which the insurer and reinsurer shares premiums and losses according to a fixed percentage. It allows an insurer to retain some risk and premium while sharing the rest with an insurer up to a predetermined maximum coverage. A quota share treaty is usually named by the amount of ceded. For example, a 60% quota share means 60% has been ceded and 40% retained. The uses of quota share treaty, which are suitable for young, developing countries, or new companies or even existing company entering a new area. It is also suitable for limiting the risk for random fluctuation and risk of change, and also become as a choice when other proportional treaty are not appropriate. These are the features of quota share treaty. The first one is agreed proportion of every risk is fixed by treaty agreement. All cessions are automatically made the subject to the limit per risk imposed. Next, reinsurer shares proportionately in all losses and receives the same proportion of all premium but less reinsurance commission. Lastly, treaty is specified by stating the proportion and any one risk above the maximum monetary limit will be accepted by reinsurer. Losses above this limit are the insurance responsibility, though the insurer can use an excess of loss reinsurance agreement to cover losses that exceed the maximum per policy coverage.
These are the advantages and disadvantages of quota share treaty.
The first advantage is that the quota share treaty is in a simple form and easy to operate and administer because a fixed proportion is ceded. Next, it works like a partnership, very useful for reciprocal exchange of insurance business. Not only that, their higher insurance commission helps with cash flow. Next, quota share directly improves the solvency ratio without losing market share. Meanwhile, the disadvantages are inflexible method because the reinsured cannot exercise selection. It also does not sufficiently address the direct reinsurance requirements, cannot be used to balance portfolios, restricts the direct insurance profit-making options due to the fixed proportion. Ceding company also cannot vary its retention for any particular risk, thus pays away unnecessary premium on small and good risk. The sizes of risk retained by ceding company are not homogeneous in size, and last but not least, the treaty limits are usually small, and cedents have to arrange other treaty on top of the quota share.
Application of quota share. Firstly, is useful for the company or existing company entering new classes of the new treaties. Secondly, is suitable for the reciprocal exchange of insurance business. Thirdly, is used for the classes of insurance where other proportional treaty are not appropriate. Features of surplus treaty. Firstly is retention limit for the surplus treaty. Retention is the maximum sum insured a ceding company or ceding can retain. Secondly is ceding fit its retention at retained risk within and eats up to the limit. The retention is also known as a link. Thirdly is the reinsurance capacity or cover under the surplus treaty is expressed as multiple of the ceding company retention, example of the line. Ceding company can vary the size of the retention depend on the quality of risk. Higher retention limit is fit for the good or good risk and lower retention is poor risk. Chosen calculate individually. Each risk is calculated individually and proportional ceded ascertained. Percent of retained and percent risk ceded is different for the each risk. Thirdly is compulsory of the insurer. The ceding company is bound to cede the risk where the sum insured of the risk accept or its own retention up to the limit of the treaty. Surplus reinsurers share the original premium and loss arising from the same proportional of the risk ceded under the treaty. Okay, lastly, the surplus treaty is arranged in multiple layers. Usually, ceding company arrange more than one layers or surplus treaty, even though ceding company can extend the link. Surplus treaty can be arranged in multiple layers such as first layer, second layer, and so on. Risk can be ceded to the second highest layer when the capacity of the lowest layer is fully uttered.
The advantages of surplus treaty to ceding company. There are 4 advantages of surplus treaty to ceding company. The first one is ceding company is not obligated to transfer risk which is less than its retention and retain the bigger proportions of the actual premium. The second one is ceding company can retain a large amount of good risk and a lesser amount of bad risk by adjusting the retention limit. The third one is the ceding company retain portfolio remain homogeneous by retaining a fixed monetary limit. And lastly, a bigger treaty limit provides the ceding greater automatic capacity to accept risk freely within the limit. Next, we move to the disadvantages of surplus treaty to ceding company and reinsurer company. The disadvantages aspect to the ceding company are they tend to make error in cession computation, more administrative work especially in the early stages, ineffective to protest against catastrophic risk, low reinsurer commission as a result of anti-selection due to poor underwriting result, and need to watch for accumulations. While for the disadvantages aspect to the reinsurance company are the ceding company keep modest and good risk while the reinsurer receive a largest proportions of less desired or more dangerous risk, and this situation has caused the reinsurer to face a wide range of loss experience. Next, the applications of surplus share treaty. The ceding company will retain liability up to a certain amount with any excess liability ceded to the reinsurer. For example, XXX Reinsurance Company has underwritten policy with a coverage of 800,000 and wishes to retain 200,000 of liability. The remaining 600,000 in the liability are ceded to the reinsurer. The 600,000 is represent to the amounts covered under the surplus share treaty. However, in a certain situation, a single reinsurance treaty cannot cover the full amounts of claim. In order to cover the full amount, the ceding company must cover the remaining amount themselves or engage into a second reinsurance treaty by performing a second surplus share treaty. For example, a company net retention is 600,000 using a 10-line surplus. Each line is 600,000. Since it is a 10-line surplus, we have to multiply the line surplus with which is 10 times 600,000 equal to 6 million. As we can see from the information given, we knew that the net retention limit is 600,000 and the first 10-line surplus limit is 6 million. From the table given, we can see that claim 2, 3, 4, 5, and 6 exceed the net retention limit, which is the cedent will only cover 600,000. The remaining amount will be ceded to the reinsurer company. By using the first surplus as the As the information given, we found that one surplus will only cover up to 6 million only. If there is still a remaining amount, they can perform the second surplus treaty, which also have the same limit, which is 6 million, and the remaining amount will be covered by the facultative obligatories.
Next is comparison of features between quota and surplus. Surplus treaty is a type of proportional or pro rata insurance treaty in which the ceding company determines the maximum loss that it can retain for each risk in the portfolio. The amount is defined as a line. Every risk that provides coverage greater than the retained line is ceded to the surplus treaty on a proportional basis, where the proportion varies with the size of the risk, hence the name surplus. For each risk ceded to the treaty, the losses and the premium are shared in equal proportions. So the main difference between surplus treaty and quota share insurance or standard proportional insurance is that a quota share, the insurer and the reinsurer share in a fixed proportion each and every risk of the portfolio. For example, 80% of every risk may be ceded to the company, may be ceded to the reinsurer. In a surplus treaty, the ceding company retains a fixed amount of each risk, and this amount defines the retained proportion depending on the total size of the underlying policy. For example, if the retained line is $100,000 per risk, for a 500,000 policy limit, the ceding company retains 20%, while for a $200,000 policy limit, it retains is 50%.
Common features in proportional treaty agreement. First, duration of treaty cover. Under this, attachment and termination of treaty principally unlimited in duration, but clauses usually entitle both parties to annual cancellation. Second is termination of treaty. Upon determination, if policy remain in force, it will be dealt as underwriting basis, accounting year basis, and occurrence year basis. For underwriting basis, the reinsurer continues to provide cover until policies expired, which is known as run-off over provided by reinsurer. And then second one is for accounting year basis. The premium and losses are entered in the accounts according to the treaty criteria for the relevant accounting year. Other than that, based on this, no further change may be made once the business year has been closed. And last but not least, for the year occurrence basis, the cedent allocate all the premiums to the relevant treaty year according to the date of occurrence. And then for the attachment of cession, there are two, which is quota share and surplus treaty. First, for quota share, simultaneously and automatically with the liability of the cedent under its original acceptance. For the surplus treaty, simultaneously and automatically with the liability of the cedent as soon as the cedent retention is exceeded. So there are two differences between quota share and surplus. We go to the next one, which is premium reserve deposit. This is cedent return percentage share of the reinsurance premium, normally 35%. Is it normally used by the cedent when insurer unable to pay the claims? As a result of this, interest will be paid to insurer by cedent for holding the premium. And then loss reserve deposit, which is cedent require insurer to place some losses reserve for similar reason as premium reserve deposit, normally 90%. For the claim settlement, the reinsurer will be liable to the company for its share of the benefits by the insured under this agreement. The payment of debts benefits by the reinsurer will be in one lump sum regardless of the mode of settlement under the reinsured policy. And for the last one is bordereaux. This is a register under either contain listing of claim or reinsurance policy. The report is compiled and sent periodically to keep the reinsurer informed about its potential liabilities or expected premium.
Okay, reinsurance commission. There are three schemes of reinsurance commission, which is flat rate commission, sliding scale commission, and profit commission. First is flat rate commission. Flat rate commission is payable by reinsurer to reimburse acquisition costs and management expenses. It is applied only to proportional treaty. Commission rate varies with the country of origin, range from 25% to 40%, and normally based on OGP. Commission rate normally determined based on the acquisition and management costs and profit earned by reinsurer. Next is sliding scale commission. Reinsurance commission varies according to the loss ratio experienced under the treaty. Loss ratio is the incurred claim expressed as the earned premium. The lower the ratio means the higher the profit. So the rate of commission is inversely proportional to loss ratio. The commission is also payable based on the agreed upon with commission scale and loss ratio ranges of the previous year. Lastly is the profit commission. Profit commission is an extra commission payable to cedant over and above the flat rate commission. It is also payable at the close of each treaty year and based on net profit made by reinsurer. Reinsurer's profit will be calculated based on the agreed formula. Profit commission payable based on agreed rate multiplied by the net profit made by the reinsurer, which is normally 10% to 20%. So if there is a loss, no profit commission will be payable. Calculation of profit and loss account varies according to the accounting system. Accounting year basis, year of occurrence basis, or underwriting year basis. In the profit commission, there are three main systems for calculating profit commission, which is fixed percentage of rate of the net profit. Next is sliding scale participation as a function of the profit and the 3-year average basis. The fixed percentage of flat rate of the net profit stipulated in the treaty is a fixed percentage for calculating the profit commission. Sliding scale participation as a function of the profit is that profit commission is paid instead of fixing percentage of the profit commission. And 3-year average basis is by calculating the average profit over 3-year period. Any loss is taken into account over these 3 years.
We are going to look example of calculation quota share treaty and surplus treaty. First is quota share treaty. Based on this method, insurer can accept the risk up to 5 million with automatic reinsurance cover. So we are going to see the example. 60% quota share up to maximum of RM 1 million. On top of that, there is 5 line surplus. The company also arranged a facultative obligation with a limit of 5 millions. So at the end of the calculation, we see that quota share surplus only accept the risk 5 millions. Okay, for the example number 2, which is surplus treaty. So company net retention is 500,000 and a 10 line surplus treaty is 500,000. So the surplus limitation is 5 million. So at the end of the calculation, we see that the answer is 4,500,000 is because the total is 9,500,000. But after deducted the net retention 500,000, we only get 9,500,000. But the limitation of the surplus is 5 million, so the remaining balance for 4,500,000 will be transferred to the facultative.
Okay, this is all from Group 2. Thank you.